We have got two main accounting standards on revenue recognition, IFRS15 and ASC 606. This is also called US GAAP Topic 606. Both these standards are called revenue from contracts with customers. Key idea with respect to revenue recognition is vendor, or call it a seller, will recognize revenue when control of goods and services has been transferred to the customer. To apply the principle, standard have laid down a 5-step model. Identify the contract, identify separate performance obligations, determine the transaction price, allocate the transaction price to each performance obligation, and recognize revenue as or when each performance obligation is satisfied. Contract in this 5-step model is the key because this is where your performance obligation had been defined and transaction price has been agreed. Let us visualize as to how we will apply this 5-step model in a practical situation. We will start with the contract, and then in that contract we will identify the performance obligations. In this example, we have agreed to deliver 1 unit of air conditioning unit along with 3 years of service, and transaction price that we have allocated to each performance obligation is $1,000 for air conditioning unit and $200 for 3 years of service contract. And in the last step, we have to recognize revenue, since control of air conditioning unit will be transferred to the customer at a point in time, and therefore revenue will also be recognized at a point in time, whereas service contract will be performed over a 3-year period, and therefore revenue for service contract will be recognized over time, that is over 3 years. In a contract, vendor agrees to deliver goods and services to the customer, and this is called performance obligation. And customer agrees to pay consideration to the vendor for the performance of the performance obligations, and this is called transaction price. And by virtue of contract, enforceable rights and obligations for each party is created. In a nutshell, contract equals performance obligation plus transaction price plus enforceable rights and obligation. For a contract to exist, this must satisfy following 5 criteria. A contract must be approved. A contract can be approved either in writing or orally or in accordance with business practices. Usually, contracts are approved in writing. Rights and obligations are identified. Payment terms are identified. Contract must have commercial substance. In assessing whether a contract has commercial substance, it is important to assess any termination provisions, specifically if either party to the contract has a unilateral enforceable right to terminate a wholly unperformed contract without compensating the other party, then in such a case, contract does not exist at all. Consideration agreed in the contract will be collected. Here, you only need to consider customer's ability and intention to pay amounts when they become due. Before we get into details, let's start with the key mantra, and that is distinct in the context of the contract. Take a pause and store these words in a safe corner of your head, and let that kick in time and again. Trust me, you will find that really coming handy later on. You need to identify distinct goods and services that you have promised to deliver to the customer in the contract. Each distinct goods and service promised in the contract is a separate performance obligation. Another very important point to note is performance obligation not only includes what has been explicitly agreed in the contract, but also include those implied by customer from customary business practices or published policies, etc., provided arrangements are enforceable. To determine if a goods or service is distinct, ask following questions. Can customer benefit from the goods or service either on its own or together with other resources that are readily available to the customer? Readily available resources are those that the customer already has or can obtain from a third party. If yes, then ask again. Is the promise to transfer goods or service separate from the other promised goods or service in the contract? If yes, then goods and or service is distinct, and if no, then goods and or service is not distinct. And in this case, you must group goods and services into bundles until they become distinct goods and service, or say distinct performance obligation. It is possible that you may end up combining all goods and services as a single performance obligation in the contract. So, crux of the story is you must identify each distinct performance obligation in the contract, regardless of whether specifically agreed in the contract or implied by customary business practices, stated policies, and so forth. You will need to apply judgment and consider all relevant facts and circumstances in order to determine if goods or service is separately identifiable from the other promised goods or service in the contract. The objective is to determine whether the nature of the promise within the context of the contract is to transfer each goods or service individually, or instead to transfer a combined output to which the promised goods or services are just inputs. Final thoughts. You must identify separate performance obligation in the contract. This is critical because nature of performance obligation will decide if revenue is to be recognized at a point in time or over time. Separate performance obligation means distinct goods or service in the context of the contract. Performance obligation not only include goods or service explicitly agreed in the contract, but may also include what is implied by customary business practices or stated policies of the vendor, etc. In plain simple terms, transaction price is what you expect your customer to pay you for the goods you sell or for the services you provide. What this means, transaction price is not always the cash price. Rather, this must also take into consideration discount or any other forms of concession that you give to the customer, or even discount that you expect you will eventually end up giving to the customer. In other words, you don't only consider discount that you will give now, but you will also consider discount or other forms of concessions that you may offer in the future as well. Transaction price can be fixed amount or a variable amount. If the amount is variable, then you should make an estimate, and once you have done that estimate, you should apply constraints to that estimate, meaning you should limit your estimate to an amount such that likelihood of revenue reversal in future is insignificant. And you keep doing a true up or true down of the variable consideration at each reporting date, and any resulting changes should be adjusted in accounts on a year-to-date basis. Transaction price can be paid in cash or in non-cash forms, for example in shares of the company. If paid in cash, no problem and no estimation needed. However, if paid in non-cash form, for example in shares, then you will need to determine fair value of the non-cash consideration at the contract inception, and only if it is not possible to determine the fair value of the non-cash consideration, only then you should determine a standalone selling price of the promised goods or service, and this estimated amount will be your transaction price. And finally, transaction price may have to be adjusted for consideration payable to the customer, or for the existence of significant financing component. Consideration payable to the customer which is not towards the purchase of distinct goods and services should be reduced from the transaction price. If consideration payable to the customer is a variable amount, then you should make an estimate of that variable amount, and that estimated amount should be reduced from the transaction price. Significant financing component may exist if consideration is paid a year before actual transfer of the goods or service, or a year after the actual transfer of goods or service. Existence of significant financing component would cause transaction price to be adjusted for interest expenses or interest income. You should evaluate each case to determine if significant financing component exists, and if existence of significant financing component is due to advance payment, then transaction price will be equal to cash payment plus imputed interest expense. On the other hand, if existence of significant financing component is due to payment in future, then imputed interest income will be reduced from the cash payment to determine the transaction price. With regard to transaction price allocation, there are three key aspects: allocation based on a standalone selling price, allocation of discount and variable consideration, and allocation of change in transaction price. Allocation based on standalone selling price is the default method. So if you have observable selling price available, then just use the relative standalone selling price to allocate transaction price to each performance obligation. If observable selling price is not available, in that case you need to make an estimate of the standalone selling price, and to do this you can use one of the following three methods, whichever is most appropriate: adjusted market assessment method, cost plus margin method, or residual method. A residual method is restricted to use only in circumstances where a wide range of prices is available or a standalone selling price is not available at all or cannot be estimated. With regard to discount and variable consideration, first decide if discount itself is a variable consideration, and if it is, then discount will be treated as variable consideration, and you should allocate this to either all performance obligation or some of the performance obligation or to a specific performance obligation as applicable using appropriate method. If discount is not variable consideration, then you should allocate discount on proportionate basis to all performance obligation unless you have evidence to support that discount is applicable only to a specific performance obligation, and in that case you can allocate discount to that specific performance obligation alone. Please always remember that discount is allocated after allocation of variable consideration, meaning first you need to allocate variable consideration and then allocate discount. With regard to change in transaction price, first determine if change in transaction price is due to a contract modification. If no, for example, uncertainty with respect to variable consideration is now resolved, then allocate change in transaction price on the same basis as you did at the contract inception. But if yes, then further evaluate if modification is treated as a separate new contract, and if yes, then treat this as a new contract and a new 5-step model begin. If no, then evaluate again if existing contract is terminated and a new contract is created, and if yes, then allocate variable consideration to existing performance obligation to the extent applicable and allocate remaining change in transaction price to performance obligation in the modified contract. It is possible that contract is simply modified, for example, incentive amount is increased. In that case, allocate change in transaction price on the same basis as at contract inception. Please also remember that while doing reallocation of the transaction price, change in standalone selling price after contract inception has to be completely disregarded. Meaning, change in transaction price after contract inception will not alter transaction price allocation percentage to each performance obligation. Though use of relative standalone selling price is the default method for allocating transaction price to each performance obligation, but standard does not preclude use of other methods to allocate transaction price if that is more appropriate. In order to recognize revenue, you need to determine when to recognize revenue and how to recognize revenue. Regarding when to recognize revenue, revenue is recognized when control of the goods and services has been transferred to the customer, and control is said to have been transferred when customer has got the ability to use the asset or customer has obtained substantially all the benefit of the asset, and ability to use also include customer ability to prevent others from using the asset. Regarding how to recognize revenue, revenue is recognized either over time or at a point in time. If revenue is not recognized over time, then revenue is recognized at a point in time. Therefore, you need to first decide if revenue is to be recognized over time or not. And to determine if revenue is to be recognized over time, you need to evaluate three criteria. That is, customer receives and consumes the benefit simultaneously, or customer has control on asset or work in progress, or you have got no alternative use of the asset plus you have got enforceable right to payment. Once you have decided after evaluating these three criteria that revenue is to be recognized over time, then to recognize revenue over time you need to measure progress towards completion, and to measure progress towards completion you can use either of the two methods, output method or input method. Output method measures progress towards completion based on the value delivered to the customer, whereas input method measures progress towards completion based on the entity's effort. One of the most common input method used is cost to cost method, in which progress to date is equal to the percentage of the cost incurred to date to the total estimated cost of completion. You should evaluate each contract to determine which method is most appropriate to measure progress towards completion, and apply them consistently in similar contracts or a similar arrangement. There is no accounting policy choice here. We have finally come to the end, and this concludes this 7-video series. Thank you.